Cryptocurrency. It's a word that's been making headlines and sparking curiosity around the world. But what exactly is it? In simple terms, cryptocurrency is digital money. It's like virtual cash that you can use to buy and sell things online. Unlike traditional currencies, cryptocurrencies are decentralized. This means they are not controlled by any government or financial institution. One of the most well-known cryptocurrencies is Bitcoin. Since its inception, Bitcoin has skyrocketed in value. This surge has attracted investors and everyday people alike, eager to be part of this digital revolution. But cryptocurrency is more than just a speculative investment. It has the potential to change how we think about money and how we earn it. This brings us to the exciting concept of passive income with cryptocurrency. Imagine earning money while you sleep without actively working. That's the allure of passive income, and cryptocurrency offers several innovative ways to achieve it. Passive income is money earned with minimal effort. It's about putting your money to work for you, rather than trading your time for money. This can provide financial freedom and security. Imagine having an extra stream of income to cover your bills, pursue your passions, or simply enjoy life more. Traditional passive income methods often require significant upfront investment. Real estate, dividend stocks, and creating an online business all come with barriers to entry. Cryptocurrency, however, offers more accessible opportunities for generating passive income. With relatively small investments, you can start earning rewards through various methods. These methods leverage the unique properties of blockchain technology and decentralized finance. Whether you're a seasoned investor or just starting, understanding these methods can empower you to grow your wealth passively in the exciting world of cryptocurrency. Staking is a popular way to earn passive income with crypto. Imagine being rewarded for simply holding onto your cryptocurrency. That's the basic idea behind staking. Certain cryptocurrencies, known as proof-of-stake (POS) coins, allow you to stake your holdings. Think of it like depositing money in a savings account. When you stake your crypto, you're essentially helping to secure the network. You become a validator, verifying transactions and ensuring the network's integrity. In return for your contribution, you earn rewards in the form of more cryptocurrency. Staking is a great option for long-term holders who believe in the future of their chosen cryptocurrency. It's a way to passively grow your holdings while supporting the network's security and decentralization. Section 4. Lending a helping hand, providing liquidity, and reaping the benefits. Another popular method for earning passive income in the crypto world is lending. Decentralized finance, or DeFi, platforms have emerged as peer-to-peer lending platforms. These platforms allow you to lend your cryptocurrency to borrowers and earn interest on your loans. Think of it like being a bank, but without the intermediaries. You provide the capital, borrowers access it, and you earn interest on the loan. The interest rates offered on these platforms can be significantly higher than traditional savings accounts or bonds. Lending your crypto can be a lucrative way to put your assets to work. However, it's essential to understand the risks involved, such as smart contract vulnerabilities and platform security. Section 5. Yield farming, navigating the world of decentralized finance. For the more adventurous investor, yield farming offers potentially high rewards. Yield farming involves lending your cryptocurrency to DeFi protocols to provide liquidity. These protocols use your funds to facilitate trading, lending, and other financial activities. In return for providing liquidity, you earn rewards in the form of trading fees, interest, or governance tokens. Yield farming can be complex and requires careful research and monitoring. The DeFi space is constantly evolving, and new protocols and opportunities emerge frequently. While yield farming can be highly profitable, it's important to remember that it comes with significant risks. Market volatility, smart contract vulnerabilities, and impermanent loss are all factors to consider. Section 6. Mining pools, joining forces for greater rewards. Mining is the process of verifying and adding transactions to the blockchain. Miners use powerful computers to solve complex mathematical problems. The first miner to solve the problem gets to add the next block to the blockchain and receives a reward. Mining can be resource-intensive and expensive for individual miners. This is where mining pools come in. Mining pools allow individual miners to combine their computing power. By pooling their resources, miners have a higher chance of solving blocks and earning rewards. Joining a mining pool can be a way to earn consistent rewards from mining. However, it's important to research different pools and choose one that aligns with your goals and risk tolerance.